Good afternoon, everybody, and thank you very much for tuning in to our webinar today. I'm James Howell, and I'm the Sales Director at PFP, and today I have John Price with me, who is the Head of Direct Sales at Atradius. Welcome, John.
Thank you, James.
Today we're going to introduce a new product to you which will help your clients get through the recession and come over the other side in good shape. As we all know, we're working in tough times, and PFP Debtors Protection can provide your clients with extremely valuable protection. I'm delighted to see so many of our member firms listening today, and for those of you new to PFP, welcome. Just to give you a brief bit of background on us, we've been working with accountants as a company for nearly 3 decades, and we currently work with 1,600 firms in the UK and 9 of the UK's top 20 firms. Our goal as a company is to help accountancy firms provide added value services to their clients. PFP Debtors Protection very much does that. PFP Debtors Protection is underwritten by Atradius, who are market leaders in the field with this type of protection and insurance. So we're delighted to be working with them on that. This broadcast should last around 45 minutes. We very much hope, obviously, it will be of interest to you, and we're delighted to take any questions from you as we go through the presentation. So please don't hesitate to post any questions to us, and we'll endeavour to try and answer them during the webinar. If we're not able to, then we'll try to get back to you after the webinar and things. Just to give you a brief outline of the agenda of the webinar today, we're going to just look at the whole issue of debt and how it can affect companies, and then just look at how debtors protection can benefit your clients and also how it can benefit you as a firm. We'll also give you a bit more background on Atradius as a company, and then what the process would be for you and your clients should you wish to look at debtors protection more closely. We'll try and take some questions during the webinar, but we'll probably field quite a lot of them towards the end of the webinar for you and things. So John, over to you.
Thank you, James. The pictures we're looking at show on the left a factory which is on fire, and on the right a factory which is locked out because the business has failed. Now, the chances are that your business and indeed your client's business are insured against fire risk. But if you consider the odds and you ask yourself which scenario represents the biggest risk to your business, I think the answer is fairly clear. I mean, is it more likely that your business will spontaneously combust, or that a customer will fail, leaving you with unpaid invoices? And unless you're an arsonist, then the answer is pretty self-evident. But there's many businesses that don't choose to protect their accounts receivables. And when you think about it, when they're selling on credit terms, what they're doing is giving their customers interest-free, unsecured loans for goods or services already supplied. Now, there's plenty of research out there which will show that 40% of a company's current assets are made up of unpaid invoices. So your clients ought to be considering whether there is a more prudent course of action, and fortunately there is. So let's illustrate that point by examining the true cost of debt. Now, the cost of debt is significant, but it's easy to forget day in, day out just what an impact it can have on a company. So we thought it would be useful to go through the following chart to illustrate how important it is that your clients keep their bad debt as low as possible. A couple of words of explanation. The red numbers on the left of the screen are showing the total debt written off in a year. The blue numbers on the top line are showing the assumed profit margin that the business is working on, and the black numbers are showing the value of sales needed to recover written off date at the assumed profit margin. So if you take a company that writes off £25,000 in a year, if they're working on 5% margins, then they would need a further £500,000 worth of sales, all successfully completed, all completed at 5% margins, merely to get their bottom line back where it was before that business failed, leaving them with a £25,000 write-off. Now, if you say it quickly enough, it sounds easy. But if you think about it in the terms of your own business and you ask yourself where you would find an additional £500,000 of sales, it's not quite that easy. Now, credit insurance can't stop customers failing. But what it can do, what it does do, is put the cash back into clients' business so that they have time to rebuild their book whilst their bottom line is intact. You know, bad debt is more than just a number on a balance sheet. Bad debt is expensive. Bad debt costs companies real money, real heartache, real effort to recover lost profit. It knocks businesses off course. It throws future investment plans into doubt. And if the numbers are significant enough, they can cause that company to go out of business as well.
So John, what is PFP Debtors Protection exactly?
The heart of it is that we're providing protection against non-payment for two risks. One, their customer becoming insolvent, or two, their customer, although not formally in insolvency, not being able to pay a debt 180 days after the due date. With PFP Debtors Protection, you are getting a bundle package, and this bundle package for one fee provides credit risk assessment, a credit management protocol, an integrated collection service, an integrated legal service, and credit insurance. And the cost is fixed for 12 months. There is no reconciliation when the policy period ends, and payment is by interest-free instalments. Fundamentally, credit insurance is a business-to-business product. It covers sales made on credit terms. So to illustrate the point, if your clients are in the retail sector, then all of their sales are to consumers and debt protection wouldn't be suitable. If you have clients who are selling to retailers, then debtors protection would be suitable.
John, we just had a question come in here. You mentioned here the integrated collection service. Is that something that someone would have to use with yourselves if they took out a policy, and if so, is that a good thing?
Yeah, I think it is a good thing, and certainly we would expect them to use the service. You know, it is free of cost, and it goes all the way up to and including our having to take legal action to get the money back, and we stand all the costs. I mean, a Traders collection company is spread worldwide, and we also work for companies who don't credit insure with us. And companies who choose to use our collection service who aren't credit insurance customers include Dun & Bradstreet, Royal Bank of Scotland, and the Intercontinental Hotels Group. So, you know, it's a well-regarded organisation, and they are very good at getting money back from debtors.
Great, thank you, John.
Okay, so let's have a look at what your client gets out of buying credit insurance. You know, I think it starts with the fact that when a company buys goods or services, they have to consider, is this purchase going to make my business more profitable? And they have to consider that because that's what they're in business for. And every cost they incur ultimately impacts the bottom line. So if that cost isn't making the business more profitable, why would you want to incur it? And I would argue that that's a measure by which credit insurance should be judged. And so I hear you asking, John, will it help my clients' businesses to become more profitable? And I would give you the short answer, yes, and of course the long answer is also yes. When companies buy credit insurance, they buy a service which helps them to manage risk. By that I mean we give an early warning signal if we believe our customers are trading with companies who are going to get them into trouble. It's our job to lead them away from harmful risks and to point them towards safer risks. And I emphasize safer risks here, not safe risks, because, of course, we are underwriting risk. Now, if something happens and they aren't paid, then we're collecting the debt. And if we can't secure the payment from the debtor, then we pay out instead. Each day, a trader is making something like 20,000 credit trade limit decisions. And we do that because we have hundreds of risk assessors, worldwide with online access to 100 million customers. But it's not just about data. If you think about a retailer on the high street and they're selling, I don't know, DVDs, toys, sweets, etc., you know the sort of thing. Well, we know the toy seller, and we know the toy seller's freight forwarder, and we know the people who make their packaging, and we know the people who make the plastics for the toy maker, and we know the people who supply the chemicals to the plastic maker. So in short, we know their entire supply chain, and the same goes to the DVD supplier and the people who supply their sweets. So because we know the supply chain, we hear of all sorts of things: changes in trading patterns, changes in people, complaints on the increase, payment patterns deteriorating, credit lines being exceeded, banks being changed, people becoming hard to contact. And we get to meet regularly with companies like British Airways and B&Q, and they're not customers of ours, but they talk to us because we want and they want us to be able to underwrite their clients, their customers for them. And they show us their financials, they share their business plans with them, and if there are any anomalies even in their accounting, then they explain those to us as well. One of the senior partners in Ernst & Young, who I was with recently, describes this as our intellectual property. And he's right. That is exactly what it is, and that's exactly what we're selling. That's why companies like Samsung, L'Oreal, HSBC, Sony, Motorola, HTC, and LG trust us to help secure their world. Now, in an environment where finance is increasingly difficult to access, despite the best efforts of the Treasury, the Bank of England, the Chancellor, credit insurance can help here. Financiers want to know two things when they lend you money. One, when do I get my money back? Two, how much can I charge? The increasing use of leasing means that companies simply don't have the physical assets any longer against which a financier can secure a loan. Now, in the past, the directors' homes has provided security, but the property market is stagnant, values have plummeted. And so companies who need to borrow are avoiding their lenders because they know the current value of their property is not sufficient to justify the existing loan. And the lenders who need to lend don't really want to talk to their existing clients because they know that those current valuations can't provide sufficient collateral for existing facilities. And so that leaves paper assets, accounts receivables, as the best, often the only security for trade finance. And when those assets, those paper assets, those invoices, those accounts receivables are secured by credit insurance, funding is available, and it's available at lower rates. And that's because it provides solid security to a lender. It tells the lender that their client is taking their credit management and hence their loan seriously. Used properly, credit insurance helps to make companies more profitable by enabling it to make sales to new and existing businesses. So, ladies and gentlemen, credit is the new reality. Finance is difficult to source. So, why not buy on credit terms and borrow from your suppliers instead of your bank? Now, unless you're selling a product which is pretty unique, or you have a brand, which means you can afford to be choosy about who you sell to, the truth is that most of your customers will only buy from you on credit terms. With existing accounts, now you're going to know that they're good to say £30,000 on 30 days, but do you know whether they're going to be good for £60,000 on 60 days? With new accounts, do you really know anything about that company at all, apart from they want to trade on credit? And yes, you can take a trade credit reference, or you can take an opinion from a reference agency. But if they are wrong, it's you who is out of pocket and not them. If you credit insure, your financier will know 4 things about you. 1, that your customers have been professionally risk assessed. 2, there is a strong probability that you'll be paid. 3, if we are wrong, we put our money where our mouth is. And last year, that cost us £750 million in claims. 4, your financier will be able to fund your sales because they know that your cash flow is secure.
John, we've had another question come in from one of our listeners. They've asked, is your credit reference information better than the main agencies, in your opinion?
Yes, and it's better for a number of things, really. One, we have a huge database of businesses, 100 million worldwide. Two, we employ the better part of 1,000 people worldwide, and their job is to assess that risk. So they have the published information, but not only published information, we get many, many businesses who send us their quarterly management accounts. So we have information on those businesses which is current, not stuff that can be 12, 15 months out of date. And finally, we have risk assessors on the road, day in, day out, who are meeting individual companies, sharing their business plans with us, showing us their financials, explaining what's going on in their business, explaining their future plans. So I would argue that we spend substantially more on coming to a decision on the worth of a company than the credit information business will do, hence our opinions are better.
Thank you, John. Just one point I'd like to pick up on, if you don't mind as well, is in the current climate, can we be sure that even our existing clients really are good for the sort of level of credit that we might assume they, might have assumed a few years ago they were good for? And if anything, could our existing accounts be, the ones that we really should be, protecting ourselves against more so than the new ones? Because, there's a lot of household names that have gone under recently that we might not have expected to have gone under, and the ripple effect there can be quite significant across the economy and things.
I mean, it certainly is, and one of the things we say to companies is, look, just because you've known somebody for years and you've traded with them for years, doesn't mean they're good in the future. In fact, it's often the case that it's those very companies that you know very well who are inclined to take liberties with you, if you like, because you have an established relationship, and it's difficult because of the sort of friendships that are built up there to be realistic about what their current state is, and hence credit insurance can give you an insight into that which perhaps you can't see yourself because you're too close to it.
Yes, yeah. So how does a practice or an accountant benefit from getting involved in something like this?
Well, I think we probably made the point fairly convincingly about how the client benefits, and you might say made it with a sledgehammer, but sometimes you need to do that. There is clearly benefits to the practice. I mean, first and foremost, the client regards the practice as a trusted business partner, and I would argue that you owe it to your client on that basis to talk to them about credit insurance, and you owe it to yourself too, because there is a what's in it for you. If your clients are credit insuring, then they're going to be less likely to fail than those who don't, and it's clearly in your interest to see your clients survive and prosper, because if they're surviving and prospering, then you're surviving and prospering. If their business is insured and survives, then they're going to carry on needing your services. If they use credit insurance to grow their business and expand into new markets and trade with new customers and trade at increased levels with existing customers, then they're going to make more money, they're going to make more profit, and they're going to have more funds to be able to spend on the services you're providing. As they grow, they're going to need more of your services. And then, of course, there are the fees which PFP will share with you for the initial introduction and the sale that's been made, and for the ongoing sale when the policy renews. So I think that we can see that there is a steady flow of income coming into the practice from introducing credit insurance to your clients.
Yeah, I mean, this is something that we've set up with the traders to enable you to earn recurring additional income for the practice, and it can be quite significant. So hopefully, first and foremost, you see it as a benefit for the clients, but a nice added benefit for yourselves is also it can help to just grow your income as well. So just moving on to Atradius as a company, we thought it'd be important to just give you a few sort of key facts and figures so you can begin to understand why PFP Debtors Protection believe that Atradius really are the right partner for you and for us with this product. Firstly, just so you're all clear, PFP Debtors Protection is underwritten by Atradius, who are the one of the market leaders in this field of protection and insurance. And PFP Debtors Protection act as introducers to Atradius, and Atradius underwrite and handle all the claims on the product. But John, could you just give our listeners a bit more background on yourselves as a company?
Sure. Looking at the numbers, I think the numbers are pretty impressive in their own right. But they do, in a way, tell the story of the credit insurance industry. I mean, you've got massive exposure. Say you've got an exposure of €385 billion against a premium income of €1.5 billion. And if you think about those numbers, then it demands that we are extremely good at assessing risk, because in that exposure is the total amount that if everything went wrong, we would be on the hook for. That said, it's important to understand that we're talking about risk assessment, so that there are no certainties. It's not our job to tell our customers only to trade with companies whose creditworthiness is undoubted. It's perhaps better to describe our job as to help steer clients towards the better risks and away from the bad risks. And whilst, clearly we are right far more often than we are wrong, when we do call it wrong, and you can see that by the claims payment. In 2011 it cost us £750 million in claims paid. But if you set that £750 million against the total exposures of $385 billion, then it again underscores the point that we are actually very, very good at what we do. So
I think that's the nature of the product though, John, isn't it? You can't predict everything and stuff, and that's why this is an important product for people. Much as you're experts in having a good feel for where companies are, you can never predict what's going to happen, and that's why this is an important product for people to seriously consider.
No, absolutely. There's no certainties. So to summarise, I would say that in Atradius, that you have a profitable underwriter, strong risk assessment capabilities, international presence, and a sound credit rating.
You mentioned there on the slide that you've got 160 offices in 45 countries. Does that mean that people using this policy, it actually covers for trading with all of those 45 countries, or is it just some of them all?
No, it's actually much wider than that. What we're basically trying to illustrate there is that our collections capability is within those 45 countries. We have people on the ground in those countries who are collecting the debt for your clients in the name of Atradius, and that the way we assess the risk in some of those overseas countries, so for example, Mexican risk is assessed in Mexico City, not in London.
Yes. And you can also debt collect in all those countries and help with collecting money and things. And
our collection capabilities worldwide, but in those countries, those are the countries where we have offices which will conduct the debt collection in that part of the world.
100 million companies, information on them. There's not many. You don't have information on them by the sounds of it.
I think it's pretty impressive number, is that one, yeah.
So, getting your clients on cover, what's the sort of process that's involved there, John?
Well, the process is going to be pretty straightforward, James. I mean, essentially, we're looking for a proposal form, and those are, pretty straightforward, pretty short, really. And
so we would provide a proposal form for the clients and the accountant to fill in. Is that correct?
Yeah, and I suspect that the practice will want to help the clients with that exercise, because the practice has probably got a lot of that data already, and if they haven't, they can certainly point the clients where they're going to find it. But you're talking about basic financials, sort of how much, what levels have you traded to in the last 2 years, what debts have you had, and then who are the principal customers you trade with, and what your day sales outstanding are. And that's pretty much apart from the the company numbers and the addressing details and contact details. That's pretty much it.
I think we sort of we mentioned earlier that you as a practice can earn income from selling this product to your clients, and I think you can also make it happen a lot more quickly for your clients because you do have access to all this information, and I think it very much justifies why you should be paid income for doing these things as well. Not only are you providing an important value-added product and service for your clients, but you're going to be involved in helping to make sure that they can get a policy live and things.
Okay, so having got the data from yourselves, then we're going to provide a quote, and we'll provide the quote either direct to you, to the client, or direct to you to pass on to the client. And it's really your call how you want that to happen. They're your clients. We're not going to do anything that damages your relationship there, so we need to be very much guided by you. Once the client's accepted the terms, then we can make the policy live, and then having made it live, we give the client password access to ServerNet, which is the internet-based system by which they manage their policy with us. And the client is essentially paying for the service each month in arrears by direct debit, and the direct debit instalments are free of interest charges.
You just answered one of the questions we've had in there, so that people can pay by direct debit then?
Absolutely, yeah.
All right, great. And another question that's just come in is how much is it going to cost my clients?
That's always a good question. There's three drivers to the price, really, James. One is the amount of the size of the business they want to insure. Second is the sector they're selling into. So if you've got a client who's selling into the advertising industry, which is generally safer than, say, construction, and they would get a lower price than somebody selling into the construction sector. And the third factor is historically what's the client's performance been. So if you have a client who's had minimal losses, then that will be reflected in the price.
Great, thank you very much, John. So what are the must-dos, the things that the client has to do to ensure they get a claim paid?
Okay, I'm glad you mentioned getting a claim paid, because my view is the acid test of any insurance, doesn't matter whether it's travel, motor, fire, whatever it is, if something goes wrong, are you going to pay my claim? Well, 2011 we paid out €750 million, €750 billion indeed, in claims payments. So nobody accuse us of being shy about parting with our money. What we're looking at on the screen here are the 5 principal reasons why claims aren't paid. Now, last year we paid out 93% of the value of all claims we received. So what we're looking at are the 5 principal reasons why just 7% of claims weren't paid. I re-emphasize that, 5 reasons why just 7% of claims weren't paid. 1, the client didn't pay the premium. Now, it's a generally accepted convention in insurance that if you don't pay the premium, the insurer isn't liable. And that convention applies in credit insurance as well, not unreasonable. 2, the client has to have a credit limit on each of the customers they trade with, and if they don't have a credit limit, then I'm afraid we're not liable. Similarly, if we say the client's customer is worth £30,000 and they trade to £60,000, then our liability is at £30,000, not at £60,000. The client also needs to invoice their customer within 30 days of sending the goods or supplying the service. And again, it's not unreasonable, because if you don't raise an invoice, then your customer has got no legal obligation to pay you at all. Fourthly, we expect there to be a retention of title clause in the contract. Now, there are clearly sectors where a retention of title clause isn't valid. You can't have a retention of title clause on services contract, for example. It's not a terribly clever thing to have in fruit and vegetables, because frankly by the time you get the fruit and veg back, they've gone off and they're not much use to anybody else. So we are aware of sectors where it's not sensible to have it, and in those sectors then the client's excluded from it. But generally there's an expectation that they will have a retention of title clause.
That's just good business practice though, John, isn't it? I mean, if you don't have that in your contract, obviously there's, like you said, there's some sectors where it's probably not relevant, but for the vast majority that's just simply good business practice to have that in your contracts, isn't it?
I think it makes sense. I mean, if nothing else, it shows to your customers that you're actually serious and you're actually a professional business, and that you do know what you're doing in business.
Yeah.
And then finally, we need to be told within 60 days of due date that there is a problem. And once we know there's a problem, then we will take on the collection of the debt on behalf of the client. And when I say take it on, we don't take it over. We have a conversation with the client about how best to proceed. Because if the client says, look, I've told you they haven't paid because at 60 days I'm obliged to, but generally they don't pay till 80 days, then we're not going to go in all guns blazing at that point. If the client says, look, I'm really fed up with this person and I want you to go in and give them a good stiff talking to, then we'll do that as well. So it's a cooperation between us and the customer, because the customer knows their buyers better than we do. They know the payment patterns better than we do. They know their credit control department better than we do. So we're very much guided by them in how to chase after the debt. Okay, so I think just to underscore those points, this is why 7% of claims weren't paid in 2011, and I don't think that any of these requirements could be considered to be unreasonable or even onerous, and nor do I think can we be accused of hiding behind a small print, because these are fairly fundamental to how a business conducts itself.
So, John, how does debtors protection save clients money?
Yeah, what we've got, as we said at the outset, is a bundled proposition. Within this bundle, you're getting your credit insurance, debtors protection, you're getting information, and you're getting collection service. So you have one supplier, one invoice, one price, and that price is fixed for the year, and there's a great deal of certainty about how much you're paying. So you have the administrative savings of only dealing with one organisation, and the financial savings which come from buying a bundled package of services. Now, some companies are telling you that they provision for bad debt, and whilst they may think they do, the reality is they don't put any money aside for the proverbial rainy day. And the few that do provision for bad losses, bad debt, can't predict where those losses are going to come from with any degree of certainty. With a degree of certainty, we can tell them what the premium is going to cost them. So we have a situation where you either provision for bad debt, which isn't tax deductible, or you buy credit insurance and the premium is tax deductible, and you have a premium which is fixed and certain and known in advance against losses which aren't fixed, aren't certain, and are unknown in advance. And of course, to re-emphasize the point, credit insurance is tax deductible, provisioning for bad debt simply isn't.
I had a question come in here, John. The question from my listener says, a number of my clients use factoring at the moment. What makes, in your opinion, credit insurance better than factoring as an option for them?
I think there's a number of points there. Firstly, factoring can be expensive. If you think about how it works, on day one you're going to get 85% of your invoice paid to you by the factor. The cost for that 85% of your invoice is going to cost you about 8%. So you're really paying, so your margins are being eroded. Secondly, if the factor can't collect out on behalf of you from the client, so they can't get the money back from your buyer, then they're going to take the money straight back out of your bank account. Now, when we can't collect the money from your debtor through our collections efforts, we are putting the money into your bank account, not taking it out. So I think credit insurance is a much more valid proposition than factoring, because the costs are cheaper and you have the certainty of payment, whereas with factoring you have the certainty of if you're not paid, then you're on your own.
You're going to have to pay it yourself.
You're going to have to pay it yourself indeed.
Yeah. Great. So the next slide looks into a virtuous circle, John.
Well, do you know, there is a delicious symmetry in this. I mean, you as a practice, you interest your clients in credit insurance, and you receive fee income from PFP. As the client makes more sales, not only are they protected from bad debt and therefore less likely to fail, can help their business grow. And if it helps their business grow, then they're going to use more of your services, and your fee income grows, and then the client renews their policy, and you get your fee income from PFP again, and they make more circles. So you get this continuing virtuous circle where you benefit and the client benefits.
I think one of the things we at PFP have been very impressed with in regards to debtors protection and credit insurance is it does provide the comfort and the insurance and the protection that provides, but it also encourages clients to carry out excellent credit management and introduces, for some disciplines that they might not have been doing, such as the retention of title clause in contracts and stuff, and making sure they're following up invoices at the right time and just having a very good discipline to their credit management and stuff. And that's something we've been very impressed with, and the sort of service and support you provide on that side of things, I think, could help an awful lot of clients of practices and things. I've got one more question just come in, John. How do I get a credit limit for my client, or how does my clients get a credit limit from you?
Okay. Once the client's on cover, they have the policy, then they have access to ServerNet, which is our web-based system by which they manage the policy with us. So if they need a limit on a UK-based company, for example, then they log in, use their password, go to the appropriate screen, and they'd simply put in the company registration number of the company they're trading with. Our system will say that registration number equals this business. Is that correct? They will say yes. Our system will say, how much do you want? And they will put in how much they want and press enter, and either the system will tell them there and then, roughly 65% of decisions are made there and then, or the system will tell the client it's been referred, and then you get another look at about 24 hours before an underwriter's had a chance to review the risk and come back with a decision, yes or no.
So it's quite a straightforward process then.
Yeah, we believe it's pretty straightforward. Our customers don't seem to have any difficulties with it. There is a help desk staffed up by 6 or 7 people who are all there and available to help clients not only with the system but with any particular queries on a company they're looking to trade with.
Brilliant. Well, thank you very much, John. Just to reiterate, some of the things that we've sort of mentioned here, there's a lot of support behind this product and stuff, and if you are interested in discussing it, with ourselves more, both PFP and Atradius would be delighted to visit your offices and go through it in more detail with you. And if you'd like us to discuss it with any of your clients, again, we can do that, or you may want to do that initially. Atradius have an extremely experienced team who we've been very impressed with. I think you yourself, John, have over 30 years experience of this product, is that correct? Or?
I'm afraid so, yes.
He looks a lot younger than that. Yes, so there's a big team behind this, and we can provide you with as much or as little support as you want. If you would like more information on the product, please don't hesitate to call us on, the numbers are on the screen here, 0845 307 1177, or the email address there. We will email you after the webinar with those details. I've noticed a few of you have logged on a little bit later than the start of the webinar. We can send you a full recording of the webinar if you want, or if you want, we can also send you a recording if you want to sort of pass it on to partners if you think it would be useful for them to listen to it. But thank you very much for listening. I think we've just come in under our 45-minute deadline, and we very much hope you'd like to look at this in more detail with us in the future. Thank you.
Thank you.